Hey everyone, hope everything is going well. Alrighty, so I wanted to look at the Federal Reserve and why I believe they are pausing the data. That's what it looks like. They may raise interest rates a little bit here, a little bit there, but for the most part, this thing is pretty much over for now, temporarily, in my opinion. And I was gonna do maybe a video on my sports card channel, but people get annoyed, so that's why I do it on my finance channel. If anyone wants from my sports card channel watch it, could watch it, or my finance channel, you know, you're free to watch here. So over here on Bloomberg.com, I showed this earlier, and this is what Jerome Powell looks at, okay? A part of the yield curve that the Federal Reserve Chair Jerome Powell watches closely to monitor recession risk inverted for the first time since the pandemic hit in early 2020. The so-called near-term forward spread, which tracks the difference between expected yields on 3-month Treasury bills in 18 months and those on current T-bills, fell 14 basis points Thursday. This was from November, okay? So I have an updated graph here. This is at near-term forward spread by Anthony Dirks and Daniels. I can't pronounce his name. But anyways, this graph, like it said in the article, the near-term forward spread is the difference between the expected 3-month interest rate, 18 months forward from now, minus the current 3-month yield. The near-term forward spread is a good indicator for future stance of monetary policy as well as recessions. Okay. So I wanted to look at this from the Google document that they have provided on their website. And you could see that this is at, what is it called? Almost 100 basis points, negative 100 basis points, right? This is an indicator for Powell that, hey, look, I'm not going to be raising rates too much, right? I'm going to be cutting. And where the last time where it showed, where they had to cut, it was in 2019, where they had to pause 2019. And what happened shortly after was the pandemic, right? So that's something to note. So even if we didn't have a pandemic, Powell would have been pausing interest rate hikes, or if we would have been aggressively cutting more. When other times where you saw this indicator where they wanted to cut, I kid you not, this was around the time in 2007, like right around Bear Stearns, if I'm looking at it closely, where Bear Stearns had to be bailed out. I remember I was at college at that point, right? Negative 40 basis points. So it was showing that there was stress in the financial system. So they're going to pause at least. I mean, so in my opinion, this pause should temporarily help out the stock market, other markets as well, the collectibles market, right? And this goes on and on and on. And, just the last few times where they did this, what was this? Like 2007, 2019. All right, 2023. Where is this? 2000, right? You're talking about, this was like, what, a year before 9/11, and you had all of these events go down, right? So I believe even though they're going to be cutting rates a little bit in the next year or so, right now it looks like a pause. Like the 30-day Fed fund futures. Looking at here, right? They're showing it what Fed funds expected rate, they're saying is what, 4.6 about. That's the futures market pricing it in. Look at a year from now, right? And they're projecting a little lower than 4.6. Well, maybe a little around that range. So you take 100 basically minus this, and you're saying what, 4.4. So Fed funds rate, they're expecting a little lower a year from now. So the pause button, in my opinion, is here. But ultimately, what will probably be happening is more rate cuts. And last time they did all these rate cuts, it took some time, but you had a downturn in the economy. Now, we shall see if that is the case in the next few years. I still believe 2024 to 2025 SHTF, there will be structural problems, in my opinion. Avi Gilbert, a skilled technician, believes that you're going to have bail-ins in the economy and the whole system's going to come crumbling down. This guy is not a pessimist. This guy has been calling, for the most part, bull market since 2009, 2010. So I would listen to him, right? Sure, all of his calls have not been right, but for the most part, he's more right than wrong. Last thing I want to leave you at, for the collectibles market, 10-year tips is here, right? So if you have rate cuts and overall interest rates going down, I expect what will happen is 10-year tips will go lower, and that should be bullish for collectibles, at least in the short run. Now, if I'm right about a potential deflationary crash sometime in 2024, 2025, I would expect this 10-year tips rate to spike back up, and I would probably buy at that moment if I had some funds. I'm buying some cards here and there, but this is not like 2018 for sports cards. It's not to that extent where everything was cheap. Still, a lot of cars, in my opinion, are overvalued, but I do expect a bump up. I personally like a lot of stocks. I personally like crypto at these prices. I like some gold and silver stocks. Now, I do want the dollar to rally a bit before I add back in, but ultimately, Jerome Powell is giving the green light to probably asset appreciation. Now, it's not going to all happen at once, right? There's a debt ceiling that's going on. There's always these events with volatility in the system. So, it's not green shoots every day, but the trend, in my opinion, is higher. Now, once again, you have to do your own research before, buying and selling. I'm not telling you what to do. You got to talk to your financial advisor, or you got to absorb all the information, make the best decision for yourself and your own family. Anyways, I wanted to hear what you have to say. Remember, guys and gals, to smash that like button, subscribe if you haven't, comment down below, guys. Thank you. Bye.